I'm very pleased to be able to celebrate the 10th anniversary of the Global Premium Strategy. Last year, March the 31st, 2021, also marked the Silver Jubilee of the Global Franchise Strategy. As high-quality investors, our long-term mindset is aligned with yours. The power of compounding is a key basic to successful long-term investment. In a hypothetical example of this power of compounding at 8%, for example, $10,000 growing at a compound annualized rate of 8% a year would become $14,693 in 5 years, $21,589 in 10 years, and would be worth more than 4 times as much in 20 years at $46,610, a strong real appreciation of capital. This compounding is fundamental to successful long-term investing, as long as you have the patience for it. Thank you for being with us on this journey. Well, it's been an interesting 10 years, with equity markets continuing to rise, interrupted by the market correction of March 2020 due to the COVID-19 pandemic, and then a V-shaped recovery. Markets seemingly ignoring ever more extreme valuations, growing geopolitical tensions, and climate challenges. Over the decade, technology, and in particular, digital technologies, have acted as a disruptive and transformative force, not only for the companies we invest in, but also for the ability of retail investors to access markets. The threat of regulation has grown over the period as regulators globally start to consider the impact of the changes of the last decade on society and the environment. Companies are likely to face structural cost pressures, which might put pressure on their earnings, meaning pricing power is likely to be a significant asset in a rising cost environment. The combination of these trends for us suggests it's all the more important now for active managers to focus on stock selection and to maintain our engagement with companies for the years ahead. Well, the biggest changes in the portfolio over the last 10 years is that we now own less consumer staples and more technology and healthcare. The biggest factor driving the increase in the size of the IT weighting in the portfolio has been the cloud. 10 years ago, it didn't exist. Now the cloud has become a more powerful engine of growth. On the healthcare side, we were able to take advantage of some specific corporate spin-offs and identify that certain medical equipment and diagnostic companies had changed enough to offer the recurring revenue profile we seek in our investments. We've managed valuation risk with net sales of highly valued IT names, with the proceeds being put in more attractively valued healthcare and consumer staples companies. One of our mantras is that there are 2 ways of losing money. Either the earnings go away or the multiple goes away. Much of our recent activity has been due to worrying about the multiples. Performance could have been better had we just ridden the growth wave rather than thinking about valuation, but trying to avoid permanent destruction of capital is embedded in our DNA. The portfolio's quality-obsessed investment philosophy looks to identify companies with robust earnings and seek to minimize the chance of losing money by earnings disappearing. As active investors, we've also looked to reduce the risk of multiple compression in the face of the market's 19 times forward PE multiple. From this perspective, this leaves only a few high-quality companies we can invest in the IT sector. Not only have we avoided the most expensive information technology sector names, but we've shown discipline within the portfolio's existing holdings. We look for companies with dominant intangible assets that support pricing power and recurring revenues, along with the ability of management to sustain high returns on operating capital. One of the pluses that compounders offer is resilience in tough times. The recurring revenue protects the top line, i.e. sales, and the pricing power protects margins. Our quantitative screen looks for companies with a high return on capital, high gross margins, not too much capital intensity, returns of capital to shareholders, and a strong balance sheet. Once through the screen, the bottom-up analysis seeks to understand the intangible assets that drive high returns. Portfolio managers need to get comfortable that such high returns are sustainable against potential threats, including changes in fashion and technology, government and regulatory interventions, and the impact of economic cycles. We look for plenty of recurring revenue and a record of steady growth. For us, having a great franchise isn't enough. They also have to be well run by management. We require companies to have management who are going to help rather than hinder compounding, notably by investing for the long term and allocating capital, and understanding and managing their ESG impact and profile. The final element is valuation. We don't want to overpay even for the finest companies. Well, the aim of the portfolio is to compound our clients' wealth over time in a superior way. As a team, we believe the success of our portfolio in compounded wealth is down to its company's ability to compound earnings in a resilient way over time at sustainable high returns in good times as well as in bad. In the first instance, such high-quality companies are rare. By definition, there are few names that meet our very high-quality standards. In addition, our deep research allows us the conviction to invest in a concentrated fashion. We want to invest in a portfolio that looks different to the benchmark, in just the highest quality names in the world. The key difference between our portfolio and those of global competitors is our reduced downside participation in tough periods. For example, the global financial crisis, and more recently, the events of 2020. Resilient earnings may not matter so much in the good times, but in our experience, when the going gets tough, the combination of recurring revenues, which protects the top line, and pricing power, which supports margins, really pays off. It's important to think in absolute, not relative terms, and to invest in high-quality companies which should deliver high and sustainable returns on operating capital employed, high gross margins, and strong free cash flow generation. The portfolio's asymmetric profile, resilient earnings, and relative valuation, given the earnings and price risk in the market today, make it a relatively attractive investment alternative now. The team continues to evolve and improve with time and experience. In recent years, we've invested in our own digital technologies, which has allowed the team to easily share information through the pandemic. And we've also adapted to society's and the industry's greater focus on ESG matters, which we believe improves our investment decision-making. We've also become much more structured in our engagement with companies, as we recognize the importance of that dialogue with management as a critical way to contribute to a better environment and society. Well, I think over 25 years, the principles of the portfolio have really shaped my investment style. Investment, in my view, is about identifying great companies, seeking to understand the agenda of the people running them, paying attention to price, and doing all this with great discipline over a long period of time. I believe playing the long game, as I have for many years, of letting great companies compound, that's the hallmark of my investment style. That's an interesting question. I don't think the basics of the investment style to invest in great compounders at a reasonable price will change. However, where we find them probably will continue to evolve, as it's done for the last 10 years. This will be a mixture of finding new companies, possibly in new sectors, but also in new countries compared to where we currently invest, including emerging markets. New data and new technology will continue to play an increased role in helping us generate alpha for clients, but I don't see it replacing time-honored active stock picking. I think ESG integration will be completely mainstream, and clients will continue to require ever greater engagement with companies, and possibly may even ask for selective direct interaction with companies through the proxy voting process.